anyone trying to predict the market on a 12-month time frame can be extremely off target. And in my 25 years of investment experience, I haven't come across really anybody who's been able to consistently predict where the market will be in a 12-month time zone. Yet we spend a lot of time and energy trying to understand that. But the fact is, there are just too many events in the short run that you cannot predict, which can cause all sorts of market behavior. Equities as an asset class is probably not even worth investing into from a 1-year time frame. Because why would you buy an asset which has a 14-15% probability of return, let's say, with 35% risk attached to it? Yeah, the risk reward seems totally against you. The shorter the time zone, equities actually doesn't make too much sense. But as we start stretching out the time, the volatility keeps trending downwards. When you buy any asset class, what you're looking for is a risk reward in your favor. You would want the returns to exceed the level of risk that you're effectively taking. So just mathematically, if we go back the last 30 years on the Sensex, this has been the average experience from the market. 6-year investing and beyond produces a better risk reward relationship. And if you're on the wrong side of volatility, of course, it can be extremely painful. So most people actually, we've observed, especially if you're investing after the markets have done very well, end up experiencing the negative side of volatility, and then they don't even last that period of time. Whereas what you should be doing is really giving it time. So, we often say, therefore, that, the returns is the easier part actually, because it's fairly stable if you give it the right perspective. The problem is living through the volatility to get to those returns. The risks really are entirely in your control. If you give it time, most of the risks tend to dissipate. Time in the market is more important than timing the market. What we realize is, even if you get your timing perfect, the amount of money you put at that point in time actually becomes more important. But the amount you would have invested at that point would be very minimal or very notional. It doesn't really move the needle for you. So for all that effort, you actually don't get much of an outcome. You also have to select the right thing to buy, whether it's a fund or a stock. So it's very difficult for people to get all three consistently right. And therefore, we come back to the same point that the faster we reconcile ourselves to the fact that we don't really know. And all you know is that there are risk reward zones. And while you're in one, the best thing to do is to do nothing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.